Check.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the last week of April, getting ready to wrap up the month. May right around the corner. April showers bring May flowers. You know the whole story. So again, it's certainly been a month of April showers, that's for sure, with the market decline that we've had. Of course, hopefully this will set us up for a little bit of a better month of May. But unfortunately, as we start the month of May, we are also entering into the seasonally weak period of the year. So we are likely not through with this correction process just yet. It doesn't mean that we have to have substantially lower lows, but probably have a lot more work to do before we get past this kind of whole period. Now, a couple of pieces of good news. This week, we're going to get earnings from Microsoft, Apple, Amazon. So we're going to have some big earnings names out this week. A very heavy week of earnings. And so far, earnings have been rewarded okay. If you've been beating your estimates, your stock price has been rewarded okay over the last week or so. Misses are not really getting punished that hard because a lot of these stocks have already been hit pretty hard, so there's not a lot of selling left. So, you know, the good news is that the basic action of the market is becoming a little bit more supportive as we're here in earnings season. The other piece of good news is, and as we saw with Google last week, which just announced an additional $70 billion buyback for corporate shares, after this week, the buyback window reopens as well. So that corporate buyer of shares, which is going to approach roughly $1 trillion this year in terms of buybacks, that's a lot of support for the market. So again, that buyer that's been absent from the market during this kind of previous decline here is getting set to come back. So that should also help. It doesn't necessarily mean it solves the correction problem at all, but it should help by providing some inflows of capital into the market as those buybacks start to pick back up. And again, with Microsoft, Apple, Amazon all announcing, those are big buyers of stock. And so once they've announced, they can start buying back shares as well. Google can literally start buying shares this week. So, but that's kind of the good news here. Outside of that, it was actually a pretty quiet weekend for a change. No big announcements of any huge degree in terms of kind of market upsetting things. But markets are going to open a little bit lower this morning. Just not surprising. We had a very strong week last week. Markets were up about 5% last week, so a little bit of a give back today. Certainly not surprising. The good news is we're not opening up with a market on a Monday morning where we're down 1,000 points on the Dow like we've seen just recently. It's not that kind of selling. It's just a little bit of profit taking here. And again, this is the type of market could open weaker this morning and then rally into the afternoon. So again, there's not a lot of concern right now in the market. Volatility is dropping. We're starting to see kind of that panic come out of the market, not just in the stock market, but also in the bond market. We're seeing bond volatility drop as well. So again, we've got, the market is calming down, right? That's the good news. Now, are we through with this correction? Likely no. We've certainly got some more work to do here. And again, we'll kind of touch on this morning in our kind of our overall conversation. I have an article out this morning talking about the value of risk management during this type of market we're in. But again, when you take a look at the technical kind of setup of the markets, we're certainly in one of these periods that could last 3, 4, 5 months before we resolve this correction process. So again, we're not out of the woods. If this kind of market volatility is getting to you, it's going to continue here for a while longer. It's just something we're going to have to work our way through, just kind of suffer through the pain of it to get to the other side. But again, it'll be okay, but we just got to get through this period. And our job as investors now is just to survive that. And that's really kind of the focus of today's article that's on the website right now, realinvestmentadvice.com. It's also on our Substack channel. So if you follow at Lance Roberts on Substack, we post everything there. It's kind of a consolidation of everything at Substack. So, but again, this is just the process we're working through. We had 2 really great years, over the last 2 years, 20% for 2 years in a row. This is part of the price you pay to invest, right? You got to have a little bit of volatility. And we've certainly had it as of late, and that this will eventually subside, and markets will go on to whatever they're going to do next, and then we'll deal with that. But okay, here's what you need to know before the bell this morning. So talking a little bit about last week, a couple of good things that are going on technically within the overall markets is that we are continuing to build this rising trend line in the markets from these lows. So we've had this kind of higher lows situation that's been going on in the markets. That's a bullish sign. We want to see that. So in other words, when stocks pull back, they're not going as low as they were before. We're starting to see buyers coming in a little bit earlier. Retail buyers, by the way, have been aggressively buying this entire decline. So while institutions and professional managers and baby boomers like me, are taking a little bit of money off the market, retail investors have been aggressively buying this whole way down. So they've been in there just buying every little bit of a dip. But that's what they've been trained to do. The other good news here is that this downtrend line that we were building previously, we broke out of on Friday. So we've had that consolidation, that wedge being built here. Markets broke out of that. That's a good sign. At the same time that's occurred, we've had money flows here turn really kind of fairly decently positive. So we're definitely seeing buying come back in the markets. We're seeing investors come back in. We're still on this buy signal here for the MACD, which is also good. So we've got this kind of momentum build within the markets. We've got money flows coming back in. That's positive. Relative strength is starting to approach overbought here a little bit. So again, we're not going to rally straight back up to all-time highs by any stretch of the imagination. And as long as we kind of remain below this 100-day moving average, which is going to kind of contain prices here. And again, as we talked about before, the 50 days cross below the 200-day, that's going to provide downward pressure on asset prices temporarily. All that's providing a lid to basically how far this advance can go. So this is, as we've talked about before, this is kind of the point to where, if you kind of got caught in this decline and this was really very mentally straining, this is the rally we were talking about here to start kind of reducing some risk. Take a little bit of money off the table. Don't sell everything, right? Don't go to 100% cash. That doesn't work. But this is where you can raise a little bit of cash, rebalance your portfolio. On Friday is a good example. We added to our short position in the market. So we're just building a hedge for our portfolio. And so again, we kind of continue to use this rally to raise a little bit of cash, add to our hedge. And eventually we'll resolve this process and we'll get through this. Markets will get back above their moving averages, and then we can take all that off and we can add money back in. Adding money back to equities is an easy process, right? Recovering losses is a much bigger issue. So again, if this was really tough on you, two things probably have happened here. One, you had too much risk in your portfolio to start with. You were too aggressively allocated. And so that really weighed on you, particularly if your portfolio underperformed kind of the sell-off. If your portfolio was down more than 20% during this decline, you had too much risk in your portfolio. You were taking too aggressive of a position. Use this rally now, which a lot of those positions should have recovered somewhat, not a lot, but somewhat. But this is the time to rebalance here a bit. And I'm getting a lot of emails from individuals, that are very stressed out in this market. This is what markets do. Markets will try to chase you out of stocks and investing near the bottoms. The more pain the market can inflict, that's doing its job of getting you out of equity so that other buyers can come in and buy your stuff. So don't fall victim to market stress. You've got to manage a little bit better. And that's really going to be the focus that we get into in today's show. So stick around, more of that coming up. But that's what you need to know before the bell this morning. Articles on the website this morning as well on the value of risk management. We'll come back after the break, pick up with that. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA Portfolio Manager Michael Leibowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Leibowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Leibowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to this morning show. It's way too early in the morning for dead jokes, and I get one from Brent this morning. Anacondas can grow up to 30 feet, but most of them don't have any. And it took me a minute to get that one. I was like, I don't get it. This is what's funny about this? So, dead jokes too early in the morning. So a couple things. Again, the market's right now going through a bit of a cycle here. And, the one thing that we've talked about this so much on the show as of late, but, navigating through these periods is tough. And so I got a bunch of emails over the weekend and which I'd already written an article for today talking about, kind of anchoring and the problem of anchoring, but I scrapped that whole article and pushed it out to next week to answer a question. I got several questions this weekend about, this recent market volatility. And, it's interesting. I posted this tweet on X. We've had a massive inflow into treasuries over the last 4 weeks. And so I posted a tweet on, discussing And I said, all I said was nobody wants to buy our treasuries, despite the fact this chart shows you we've had this massive, like it's a record that we haven't seen in quite a while of this inflow into treasuries. And it's amazing how many people actually don't look at charts. They just respond to comments. And they're like, yeah, nobody wants to buy our treasuries. And there was this whole big, long debate on this whole issue. And this tweet has gone by far, become one of my record tweets ever on kind of what's happening on X. But, it was interesting because, these are the types of narratives, and we've talked about this a lot, that people get kind of swept up into. And this is where, as we've talked about the last several weeks, just, during these corrective processes, we start making all of these psychological, emotionally driven mistakes, et cetera. And but this is where that value of risk management really kind of starts to show its teeth, so to speak. And this is the part that we forget, is that we have the ability to reduce our risk in the markets. And for some reason, there's this narrative that's generated by the markets about, you can't be out of the market, you're going to miss out, and those type of things. And it's okay, right? I mean, it's the thing about investing is we don't have to be invested all the time. It's okay not to be invested sometimes. Because at the end of the day, what's the whole goal of investing, right? Our whole goal of investing is whether it's stocks or whether it's gold or whether it's Bitcoin or real estate or whatever asset it is. What am I really trying to do? I want to buy something when it's cheap, and I want to sell something when it's expensive. And this is always kind of the fascinating thing to me about people when it comes to investing, is that they'll spend hours. I have a neighbor of mine, and he's a funny guy. He will spend weeks. And I'm not this way, but he will spend weeks researching something before he buys it. I mean, he will understand everything there is to know about a drill before he goes out and buys the drill. And he'll research every provider, every manufacturer. He'll research, all the reviews. He'll do price comparisons, all this. He does an immense amount of work to buy a $30 drill. And he's very proud of it when he actually buys it. He can tell you Brent, people like this too? Yes, my father. Oh, Brent's dad. Same way. Very proud of it. When he makes the purchase, very proud of that purchase. I was talking to him the other day, though, about the market, and he's like, I don't know, it's just, the market's killing me. It's just, it's just down. I just, and I'm like, well, sell something. And he's like, well, I can't. Like, why can't you? But this is the funny thing about investors, right? They want to buy stuff when it's the most expensive, and they don't do the research. They just buy it because it's going up. And we've seen this lately with gold. Massive inflow into gold. People come up with all kinds of narratives why gold's going higher. And so you got to buy it, right? It's going up. I got to buy it. But, you look at a chart, it's grossly overbought, technically. It's expensive on multiple levels. And so it's going to have a correction at some point. Now, wouldn't it be better to just wait for it to have a correction and buy it cheaper so that you have a better opportunity to make money in the future? I mean, that's kind of logic, right? And that's what we would do if it was a drill and we were going to go buy a drill. We research everything, try to find the cheapest price. But for some reason, we don't do that when it comes to investing. And this is because of the narrative that's driven by the market. The market, the Wall Street has driven this narrative into individuals that, oh my gosh, you're missing out, right? It's going to go up. You're missing out. You better be in it. It's going up. You're going to miss out. Look at all this money you're missing out on. And the problem is that for most investors, they wind up making poor decisions that wind up not working for them over time. Because the people that bought it at much lower levels, the professionals, they're the ones selling you. You've always got to remember this, is that whenever you go buy something, somebody's selling it to you, right? So somebody else is going, okay, I've had huge gains in this. I'm going to take some money off the table. It's, it's technically overbought, whatever it is. And I'm going to take some money off the table. So you're going to buy it. Well, this is the very basis of the greater fool theory, which is that everybody buys something expecting it to go higher, and then they can eventually sell it to somebody at an even higher price. But that doesn't always work out. And for most investors, it doesn't work out over time. And so this is why understanding kind of some very basics about risk management is so important. Here, I wrote this chart about the value of risk management this morning. This is a chart. This is a weekly drawdown going from 1960 to present. If you're driving your car, don't worry about it. It's all in the article. It's both on Substack at Lance Roberts as well as the website realinvestmentadvice.com. But what this chart shows you is this is the average historical drawdown over time. So it's a 52-week average of drawdowns. And you'll notice that when you get into some periods like COVID, right, you have much bigger average drawdowns during those periods than you do during more corrective, calmer phases of the markets like we're in now. But we've had a fairly decent drawdown over the last few weeks. It certainly induces risk into the markets when we have these type of drawdowns. And again, these drawdowns can be significant at some point in time. And generally, these times where you have very significant drawdowns in the markets, 2000, 2008, 2020, there are exogenous events that are going on, right? COVID, financial crisis, those type of things. So you're shutting down an economy, you're having a credit crisis, you've got massive bankruptcies going on during the dot-com crash. Outside of that, drawdowns tend to, kind of average around 5%-ish overall, going back through history on a 52-week basis. So again, just, trying to keep some of these things and context is very important. But, we've had a very substantial drawdown here over the last couple of months. I mean, we're down 20% peak to trough. Okay. And, we're going to change charts. So this is where two things occur that are important to understand. There's a thesis, and this is one of the worst things you can do as investing, is to assume the market returns an average rate of return over time. It does not. Yes, I can average the rate of return over time, and that is fine, but markets do not compound at an average rate of return. Bonds compound over time because I get an interest payment every single year, and if I hold the bond till maturity, I get all my money back. That's why Benjamin Franklin's trust is only invested in bonds. Stocks go up and they go down. And one of the biggest fallacies of the financial markets is that markets compound over time. They do not. And one of the mistakes that is often made in investing is, you'll hear this on the media, is like, well, if you just, invest $100 into a Roth IRA and it compounds at 6% for the next 30 years, you'll have $1 million. It doesn't work that way. If it did, everybody'd be rich. But declines in markets, corrections, destroy the impact of compounding. Let me show you this chart. So what this does is this takes the markets historically, going back through history, and it's true, going back to about 1965, markets have compounded at about 7% or so over time. And if I project that forward and use the same kind of volatility going forward, we can generate a model return going forward of 7% annualized going forward, which is okay. So if I can run that model out and I make 7% every single year, my portfolio, which is this kind of blue shaded area, would have this massive growth rate over time. Problem is markets don't do that. And they've never done that. And so if I start looking at inflation adjusted returns, an actual growth of a $10,000 portfolio, there's a big gap between what the market actually gave me versus what I expected the market to give me on these compounded return bases. And the reason for that is the impact of losses or destruction of capital. Getting back to even is not the same as growing money. Therefore, if I have a decline in my portfolio of 5 or 10% in a given year, I destroy the power of compounding by having losses. And it affects my future outcomes. Now, there's no way to get rid of volatility. And there's no way to get rid, you're never going to get compounded rates of return in markets. But we can improve those outcomes by applying some simple risk management to markets. And we'll talk about that when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA portfolio manager Michael Leibowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Leibowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Leibowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I've never seen so many economists and financial people become epidemiologists in my entire life, right?
It's a Christmas miracle.
I know, right? If your choice is death or listen to Lance Roberts, I'm sure I might win at least 20% of those.
Listen to the Real Investment Show podcast from your favorite service. Same show, your schedule at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So just talking a little bit about the importance of risk management and, looking at ways to just try to mitigate some risk somewhat during market declines. Because again, the destruction of capital, and I think this is one of the more kind of cavalier things that a lot of people say in the media, financial media in particular, is, well, market's correct. Don't worry about it. Yeah, they do correct. But you should worry about it. If you're taking significant impacts to capital. Now again, we have, and this is, so like I said, I had an article for today to talk about anchoring, and I push that till next Monday, so we'll have that one out next Monday. But markets do go up and down, right? There is volatility in markets. And when you have 2 years of 20% gains, you're going to have a year where you're going to lose some money, right? That's unavoidable, right? And you should expect that. Volatility is the price we pay to invest if we're going to take on risk. But we don't necessarily just have to allow corrections to just create mass devastation to our wealth when they occur. We can control it to some degree. And this is why we talk a lot about, y'all get on me in the chat about, Lance always saying take profits, reduce risk, rebalance. Yeah, when markets are screaming higher, it's like, yeah, take some profits, rebalance risk. And we're always doing that, right? We took some profits in NVIDIA, we took some profits in this, and we rebalanced this over here. That's that ongoing process when markets are going up. We're okay with taking some chips off the table when markets are rising. And that way, when we do have corrections, we've already banked a lot of those gains. So we're just not giving them all up. But this is where you're chastised by the media. It's like, oh, if you sell something along the way when it's going higher, then you're not going to get. Yeah, you're not going to get everything, right? But what Wall Street tries to push on you is this idea of being greedy, right? Because the more greed you have, the more you buy, which means the more stuff they can sell you. And this is the one thing to always step back and think about. And as I mentioned before, whether it's Bitcoin or gold or stocks or bonds or whatever it is, right? When somebody's telling you that this is the time to buy it, do your homework. Because if they're the person telling you to buy it is generally the person selling it to you. So if it's the time to buy something, then why are they selling it? Think about it this way. Gold is a great example. We've talked about this recently because gold's had this huge run, right? It's had this very speculative burst and it's going higher. So if I'm a gold dealer, why would I sell it? Why would I just sit on the gold, right? Because the more I hold in gold, the less supply there is for the market, which drives the price up even more. So why would I sell it? But yet gold dealers are selling gold every single day because that's their job. They don't care what they sell it to you for. Their job is to buy it at one price and they sell it to you at another price. They make the spread in between. But this is what we have to think about all things, right? Whether it's stocks or whether it's bonds, whether it's Bitcoin, whatever it is when things are going through this process of rising, we need to ask ourselves, well, is this the better time? We need to do our research, right? We need to go do our research and say, is this the time to buy it? Or should I wait, be patient, and wait for a better opportunity? Yeah, but I might miss out. Yeah, you might miss out some. It's okay. If I can invest my capital at better levels, I'm going to do better long term, which is our goal. Our goal is to buy cheap, sell rich. That's the end. That's it at the end of the day. And we might miss out a little bit in between, but that's okay. This is a long-term chart of the market. It's going back. It's not long-term. This chart goes back to 2000. It's hard to believe it's 25 years, but yeah. Your 25-year chart of the market. The blue line is the 40-week moving. This is a weekly chart. 40-week moving average. The red line is a 200-week moving average. Now, what you'll notice is that the 200-week moving average tends, and particularly since 2009, has been running support for the market. And when you look at a chart like this, you can see the current correction is not that big of a correction relative to what we've seen over the last 15 years. It's kind of a normal correction, right? But a lot of fear in the markets right now. But it's not that big of a correction. What is important, though, is that we violated that blue line. That 40-week moving average has been really good bull trend support during markets. And when you violate that 40-week moving average, that's been a time that you kind of want to take some risk off the table. Now, that doesn't mean sell everything. That doesn't mean go to 100% cash And a lot of people, and I even address this in the article that's on the website, is that they go, well, why wouldn't you just go to, when you violate the 40-week moving average as an example, and this is a very simplistic example, by the way, well, why wouldn't you just sell everything and then just wait for the market to go back above the 40-week moving average? Because you actually perform worse doing that. Because of a couple things. One, it's very hard to go from zero to something. So yeah, you may get out. So the market violates the 40-week moving average and you get out entirely. And then the market rallies like it did last week, and you have money coming back in. It's like, oh yeah, but we're below the 40-week moving average, going lower for sure. And then the market gets back to the 40-week moving average. Yeah, but it's a bear market rally, and this is going to fail, and it's going to go lower. And so you keep coming up with all these reasons why you can't get back in the markets. And this is why getting out of the market entirely, and this is what you'll hear a lot of people say this about market timing. Getting out of the market entirely, that's market timing. Trying to be all in or all out of the market is market timing. That is a losing investment strategy over time because it is non-repeatable. You may get it right once, maybe twice, but you cannot repeat that process of being all in or all out of the market because your psychology is going to start weighing on you. You come up with excuses why, I know it's got above the 40-week moving average, but it's going to fail, right? It's going to go back down again, and then it kind of keeps going. So this is why we talk about just reducing risk. So I create a very basic example in this article that you can go look at. And the article is basically, or this example is saying, okay, look, what would be the difference if I just bought and hold the S&P, I don't worry about it? Or if when I break the 40-week moving average, I just remove half my equity exposure. And then when I'm back above 40-week moving average, I add that back in. Now, the reason for just half the exposure is that if there's and this was a question I got in chat, what about getting caught in a short squeeze? Which can which can happen, and it's going to happen. Which is what this is why you have these very strong rallies like last week. Is that short covering that's driving the markets higher? Well, if I have half my money still exposed to equities, despite what's going on in the markets, when you have these short squeezes, I participate. And now I can start to try to pick through the rubble with that other 50% cash I have sitting over there, and I can start finding real value. And then as the market starts to recover, and now I can see that, hey, we're back above the 40-week moving average. We've gotten this past us. Now there's a lot of stocks that are a lot cheaper than they were previously that I can go buy with that 50% cash, and I can get better value for my money. So what this chart shows you, though, is that we break the 40-week moving average. We reduce half our exposure. We put it back on when we get back above the 40-week moving average. The difference between the red and the blue is the difference between the risk management approach versus the buy and hold approach. This is on a $100 investment. So on $100, basically on a buy and hold basis, I get about $300 versus about $1,200 with a risk management approach. So I grossly increased my returns over time by managing risk. Did I miss out on some of the market run? Absolutely, right? But because I wasn't spending so much time getting back to even, it allowed my money to compound. Now, look, this is a very basic example. And I'm not saying this is the method to use. I'm just saying there's so many methods of managing risk that are available to you. And how you approach it is entirely up to you. And again, this is just a very simplistic example of an approach to managing risk. But anything that you do to reduce your equity drawdown during corrections allows you to improve your returns by putting capital back to work. And as you know right now, we're running about 12% cash in our portfolios. We've got we're increasing our short position in the portfolio. So we've got hedges put in place. We're raising cash. We've got our bond exposure as well, very short duration, most of it. And so that's hedging all the risk of this decline. Now, once this decline is over and we get through this correctional process, it's very easy to take the cash, put that back to work, remove the short position. So that's easy to get back to full exposure, and then, even overweight exposure, reduce our bond exposure and increase our stock exposure, which we will at that point once we get through this process. Because again, once you get through this correctional process, you'll have another bull market cycle that'll last, 12, 24, 36 months before the next correction. But that is the value of risk management, because it gives us a couple of different things that are going on. Brent, bring up this next chart. This is where we are currently. There we go. So in the markets right now, we're below the 40-week moving average. We should be running reduced risk. We're still above that 200-week moving average. So again, this is, we could have a further correction. And again, it's not uncommon for markets to test that 200-week moving average. We've done it multiple times going back to 2009. So there is certainly some downside risk. And so having a hedge, having cash available, that helps mitigate that risk. But if the market does take off and we get back above the 40-week moving average, again, it's easy to get back on. We're in that correctional process. That correction process is continuing. It is not over despite the rally we had last week. That was a reflex rally off of depressed lows. We're likely going to retest some lower level at some point in the next month or two or three. And that could be a lower level, which is why we want to continue to manage risk for the time being. All right, we'll come back from the break, wrap this up. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Our next edition of Candid Coffee features special guest RIA portfolio manager Michael Leibowitz for an insightful look at the bond market, interest rates, and the outlook for your money. Saturday, May 3rd. It's an open chat edition of Candid Coffee with Michael Leibowitz and Richard Rosso. Register today at realinvestmentadvice.com and submit your questions for Michael and Rich. Candid Coffee with Leibowitz and Rosso. Saturday, May 3rd at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover, or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, just welcome back to the show this morning. So again, that article about risk management is on the website. It goes through everything, just kind of discussing, kind of navigating these more volatile markets. Again, because it's just, the number of emails that I get of people making very bad investment decisions based on primarily on emotion, what they see on some YouTube channel, what they read on some blog post out there. It's like, oh, I read this article that, this is happening, right? Okay, none of that makes sense. But it makes great headlines, right? This is, but if we just go back through history, we've had these headlines kind of over and over and over again in different forms, and the worst outcomes never come out to be true. And if you haven't read the article, we touched on, I told you last week that I was writing an article for this weekend for the newsletter. And if you haven't read that newsletter yet, It's posted. It's called Spock and the Logic-Based Approach to Investing. And, I went through and I found these, asked ChatGPT to give me some quotes from Dr. Spock as it relates to investing. And what was kind of the takeaway of this is that, and we've talked about this before, is that the mistakes that we make as investors is to assume that these more dire outcomes are going to actually occur. And you can bring the chart up. And this is a bell curve of events. So we've talked about this on the show before. But bell curves are about probabilities and distributions of events. And loss of reserve currency, nobody wants to buy our debt, we're going to go bankrupt, all these type of things. Could those happen? Yes. Those are events that could possibly happen. Nuclear war, meteor strikes from, Armageddon with Bruce Willis happens, right? All those things can certainly occur. The worst possible outcomes can occur. But they're very, very small probability events in the grand scheme of things. And so we start leave it up for a second. So when we start putting these up onto a bell curve distribution, we can say, okay, look, what is most likely to happen versus least likely to happen. And when you start talking about distributional outcomes in terms of standard deviation, once you start getting out into economic Armageddon, and conversely, on the other side of this, economic perfection where everything's going right, those are a 0.14% possibility. Very, very small. It can't occur. And if it occurs, ain't nothing going to matter. This is the thing. And people talk about, why do you own gold? Well, I own gold because if everything collapses, it won't matter anyway. You're not going to survive more than 7 days. I don't care if you've got gold or not. You don't know how to go out and forage for food. You don't know how to go out and hunt. You don't know how to plant, herbs in your backyard and grow a garden. You've been sitting around your house watching television with your feet propped up, drinking beer for 12 years. Ain't going to happen. You can't run a mile, right? None of that's going to matter. If economic Armageddon happens, pack it up, buddy. You're done. Now, there's going to be a few guys, right? I have a couple of Danny Ratliff is one. He's going to survive just fine, right? He's in South Africa right now hunting water buffalo or something. I don't know what he's out there doing, but he's out there with a knife and Rambo paint on and, stalking predatory animals. He'll survive just fine. My next door neighbor with the drill, he ain't going to make it. No chance this guy makes it more than a week. So what we have to focus on are the things that we can control and focus on the probabilities versus the possibilities. And when we allow these very small possibility events to infect how we invest our money, this is where we make very bad, emotionally driven decisions. We chase assets that we shouldn't chase. We disregard assets we should be paying attention to and make all these kind of convoluted excuses and rationalizations as to why we're doing things. And then when things go wrong, then we start rationalizing why they went wrong, right? And we just keep compounding the mistakes over time. And this is the whole point of the article, again, kind of with our conversation today about risk management, is learning to be unemotional about investing. It's just money. And I don't want to sound cavalier when I say it's just money. What I mean by that is you've worked very hard for that money, right? You've put in the hours, you sacrificed at work, you sacrificed at home, whatever you did to build those savings. They're hard earned. But we have this very cavalier attitude about how we invest it. And we just expect it to go up over time if we just do what the media tells us. Or, we listen to some guy on YouTube or read some blog post or whatever it is, and we start making these investment decisions without really making or doing the effort, making doing the research to understand why we're doing these things. And again, a lot of these emails I get, they're the most wild reasonings. I'll tell you a good one right now is we have to refinance $9 trillion of debt this year. Oh my gosh, there's no, we're just going to go bankrupt. We can't refinance $9 trillion of debt. It's all short-term bills. Over the last few years, the government's been issuing very short-term debt, short-term T-bills that are maturing. So if I'm a pension fund, hedge fund, mutual fund, money market account, whatever it is, I'm holding these bills. And when they mature, guess what I'm going to do? I'm going to roll them over. We're not having to go out and find new buyers for $9 trillion in debt. It's the same buyers. And more importantly, this. If you don't understand how the bond market auction works, you're missing out on the biggest thing, which is that there are 20 primary dealers that have to buy the bonds. It doesn't matter whether it's 9 trillion or 50 trillion, the 20 primary dealers have to buy the debt from the government. It's a requirement. They can't be a primary dealer if they don't. If they default, they're done. They'll go get a different primary dealer. So the refinancing of the debt, it's not all happening at once, by the way. It's scattered out all across the year. So it's not like there's an auction of $9 trillion. That's not happening. And more importantly, the Treasury and the Fed will also stand in as buyers if they need to. So the refinancing isn't an issue. It'll occur. Could rates go up a little bit? Sure. But they're not going to go to 15%, and you're not going to have a massive default on debt. That's not going to occur. We cannot default on our debt because we can print currency. We can print our own currency. We will always make our payments on our debt. It's mandatory spending. It's in the budget. The interest payments are a mandatory expense on the budget. It gets paid no matter what. But these are the fears that are running around that people are making decisions based on that have no basis in reality. So we need to focus on what we can control versus what we can't control. We can't control economic Armageddon. We can control the normal distribution of bell curve events between an economic slowdown, potentially a recession, or some economic growth, and how that impacts our market outcomes. And right now, we're having an economic slowdown. Right now, economists expect the economy will grow at about 1.4% real this year. That's down from 2.5% last year. So definitely slower economic growth. That is going to weigh on earnings. Even though earnings estimates have not been brought down a lot yet, they will come down because of slower economic growth. That's going to impact valuations, which suggests that probably we've seen the highs for this year. We might get close to being back to all-time highs at some point this year. That's possible. But we've probably seen the highs for this year and maybe next year. We may go through a couple of years here where markets just kind of grind sideways for a bit. We have kind of a big trading range. We've had those before as we kind of work through this process and get the economy back on track, et cetera. But the economic slowdown was inevitable because of all the money we injected into the economy during the last administration is now coming out. It's been spent, and there's no more coming in. We don't have anybody to replace those $5,000 stimulus checks to households or $1,500 check stimulus checks to households or the student loan debt forgiveness or the moratoriums on rent. We don't have anything to replace that. Mortgage debt defaults are risky at this point. We're seeing delinquencies on credit card payments, mortgage payments, et cetera, going up. We're probably going to have some defaults, but it's not going to be 2008. We don't have subprime debt. But certainly going to have some risk within the economy of slower economic growth, potentially a recession. And a recession is well within that normal distribution of outcomes. And we need to be aware of that, but a recession isn't a financial crisis. A recession isn't a dot-com crash. A recession is just an economic slowdown that's going to impact earnings and going to bring valuations down. Does that mean markets have to fall 50%? No. They could just grind sideways for a while. But these are the risks that we have to logically think through
And this is why using some basic risk management approaches to portfolios will help you survive these periods of the unknown, because we don't know what the outcomes are going to be. But we have a pretty good idea that it's not going to be economic Armageddon or economic perfection. It's going to be somewhere in between. All right. Both those articles, the newsletter, Spock on investing, as well as the value of risk management, they're both on the website now. Also on our Substack channel at Lance Roberts. Read those. Let me know what I can do to help you out. We'll see you back here tomorrow with John Penn. Have a great day.